Okay, let's unpack this. Today's deep dive into the digital asset market presents a massive, almost bizarre contradiction. If you look at the price action right now, it is pure, unadulterated, pain technical breakdowns, synchronized institutional exits, extreme psychological fear. But if you peer beneath the surface, beneath the noise, we are seeing a flood of powerful long-term foundational progress happening simultaneously. It feels like two completely different markets running parallel.
That feeling of disconnect is spot on, and it really defines the current landscape. We are in a state of profound structural divergence, where short-term tactical pain is clashing directly with long-term strategic value creation. Our mission today is to give you the blueprint of that conflict. We've extracted 15 critical developments across 4 core themes: market capitulation, institutional bifurcation, macro entrenchment, and ecosystem maturation, so you can clearly distinguish the noise of rapid price action from the undeniable signal of value being built.
And we have to start right where the pain is most acute. Market capitulation. We've seen a brutal week. Bitcoin has fallen to a 5.5-month low, and we have inflicted some major technical damage that has reset the posture of the market. Tell us how bad it got.
It got bad fast. We broke this psychological $110,000 barrier, which was hard enough, but the real technical failure was losing the significant $108,800 level. We dropped through that like a stone, hitting an intraday low of $103,566. This is exactly what you meant by a shift in posture. The market is no longer just consolidating or pausing, it's aggressively searching for new support levels to the downside.
When you look at the charts, which specific number defines the battleground right now? Where's the line the bulls absolutely have to hold?
The line in the sand is the $106,000 level. What's fascinating here is how technical levels flip roles. That $106,000 to $108,000 band was major, tested support for months. Now that it's lost, it acts as initial overhead resistance. The market has to claw back and convincingly hold $106,000 to signal any short-term hope.
And if they fail to reclaim that former support, what's the downside target then?
Well, it confirms the technical breakdown, really. It paves the way for a deeper sell-off into the $100,000 to $102,000 secondary support range. And if you're looking for any indication of relief, the overhead resistance is formidable, firmly established in the $115,000 to $117,000 zone. Short-term, the technical picture is highly bearish, and the psychology, well, it just confirms that breakdown.
Absolutely. My inbox is filled with panic. And the Crypto Fear and Greed Index confirms it. It's crashed to a yearly low, hovering between 22 and 24. That means we are firmly entrenched in extreme fear, a reading we haven't seen since, April 2025? People are capitulating, liquidating positions, just throwing in the towel.
Right. And this extreme fear is where we introduce our first element of divergence. While retail panic is high, remember that analysis from institutional sources like Bitwise frames this very extreme fear as a potential accumulation opportunity. What's interesting about the specific index reading is that historically, these moments of maximum retail and tactical fear often precede seasonal strengthening. It suggests the pain is being driven externally by macro factors, not necessarily by a flaw in the fundamental asset itself.
Okay, let's follow that external factor idea into actual money flows. This leads us nicely to institutional bifurcation.
Yeah.
You mentioned we have one type of institution running for the exits, while a different, more strategic type is just walking right in the door.
Yes, the tactical exit was a landmark event that really rocked the market this week. For the first time ever, we saw a synchronized net outflow across all U.S. spot Bitcoin ETFs. This wasn't just one bad actor. It was a coordinated de-risking event that totaled over $500 million, specifically negative $530.9 million in a single day, last Thursday, October 16th.
Wait, $500 million vanished net in one day. That fundamentally challenges the narrative that institutional interest is just this unwavering thing. Who was leading that mass exodus?
The leaders were the funds typically favored by more liquid short-term tactical players, think hedge funds, or asset managers utilizing the ETFs for fast liquid exposure. ARC21 shares led the outflow with netting $275.2 million, and Fidelity followed right behind with netting $132.0 million. This tells us that short-term players were using the ETFs precisely as intended, as a highly efficient vehicle to rapidly de-risk when macro headwinds hit hard.
Okay, so that's the tactical fast money leaving. Now let's look at the strategic, slow-moving, perhaps more permanent capital entering the picture. The story flips entirely when we look at state policy. Florida lawmakers have introduced House Bill 183. What's that about?
This is potentially enormous structural demand with a multi-decade horizon. The proposal would allow the state to invest up to 10% of state and public pension funds, including the massive Florida Retirement Systems Trust Fund, directly into digital assets or SEC-registered ETFs. When you are talking about state pension funds, you are talking about billions of dollars that operate on a 30-year timescale, not a 30-day timescale. This signals legitimization at the highest state level.
And this structural demand isn't just government. The corporate treasury thesis, where companies hold Bitcoin on their balance sheet, that seems to be expanding far beyond the early adopters too. Nasdaq Q-listed Harrison Global, BLMZ, announced a binding term sheet to launch a Bitcoin treasury strategy.
Exactly. This proves the corporate playbook is being adopted by a new wave of public companies looking to diversify reserves and hedge against persistent inflation. They're treating Bitcoin as an alternative monetary asset. Furthermore, we saw a major inflow of Asian institutional capital this week. Hong Kong-listed DL Holdings Group announced a comprehensive strategic partnership valued at up to $200 million with Antelfa, and that capital is being split across two distinct and highly strategic areas of the ecosystem. We'll get to that.
So we have the short-term tactical money being sold off, maybe, potentially right into the hands of permanent institutional buyers. But we absolutely must address the primary fuel for this entire risk-off environment. The global macroeconomic backdrop, what we're calling macro entrenchment.
Yeah, the structural headwind causing all this pain is the persistent U.S. China trade conflict, which has fundamentally changed its nature. It's no longer really a transactional trade war that can be resolved with tariffs. It has evolved into something more like a structural trade divorce. Chinese manufacturers are explicitly viewing the U.S. as an unreliable partner, forcing them to pivot their supply chains and actively seek massive new markets in places like Brazil, Southeast Asia, and Europe.
And we aren't talking theoretical shifts here. We have the quantitative proof of this happening in real time, right?
Yeah.
China's overall global exports grew 8.3% year over year in September, showing resilience. But exports specifically to the United States fell by a staggering 27%. That's the sixth straight month of decline. That is a structural separation.
And that structural separation injects profound uncertainty into global growth forecasts. If we connect this back to risk assets, persistent uncertainty is a structural drag that hurts pretty much everything deemed volatile, including Bitcoin. This raises an important question. Why is traditional safe haven gold hitting record highs right now while Bitcoin is capitulating?
That's the critical challenge to the digital gold thesis, isn't it? If geopolitical stress is at its highest and gold is soaring, why hasn't Bitcoin acted as the safe haven everyone promised? Is the fundamental drag from global instability simply too powerful for the asset to overcome right now?
It certainly seems to be in the short term. The capital flight is prioritizing traditional stores of value that have decades of proven correlation to geopolitical stress. It's leaving Bitcoin to be traded alongside, say, equity tech stocks as a high beta risk asset during this specific macro moment. This is a crucial distinction for you to internalize.
But despite the macro headwinds, despite the $530 million tactical exit, foundational building, what you call ecosystem maturation, that continues completely decoupled from the negative price action. Let's look at 3 layers of long-term progress that are happening right now.
Okay, let's start with self-custody and core infrastructure. Tether, the stablecoin giant, released its Wallet Development Kit, or WDK, as a new open-source tool. The WDK is designed to help developers easily build secure, multi-chain, self-custodial wallets supporting Bitcoin, the Lightning Network, and multiple EVM and non-EVM chains like Solana and Ethereum.
Look, the stablecoin giant is pushing open-source self-custody tools. Why does that matter for the average developer or, user?
It matters because Tether is significantly lowering the barrier to entry for building non-custodial financial products. By making the tools to build secure, multi-chain wallets free and open source, they accelerate the transition of users away from centralized custodians. It reinforces the core decentralized ethos of the entire market. It's infrastructure for long-term decentralization, essentially.
That's a huge structural boost. Okay. We're also seeing major convergence with traditional Wall Street finance through real-world assets, or RWAs. NYSE-listed fintech company Yarin Digital, YRD, partnered with ChainUp specifically to focus on institutional-grade crypto products and, critically, the tokenization of real-world assets, RWA.
Yes, and the RWA thesis is gaining critical validation. Remember that $200 million deal holdings partnership we mentioned earlier? A full $100 million of that commitment is specifically allocated to tokenized gold, XAURO. This is a massive endorsement. Institutions are signaling they're serious about leveraging blockchain efficiency to represent traditional assets, bypassing traditional constraints in asset markets like settlement times and transparency.
And what about securing the network itself? That DL Holdings partnership had a second pillar related to infrastructure, didn't it?
Absolutely. The second $100 million pillar is a massive investment in Bitcoin mining infrastructure. DL Holdings is acquiring nearly 3,000 Antminer S21 units, with a medium churn goal of producing approximately 1,500 BTC per year. They are treating Bitcoin production as a secure, industrial-scale enterprise. This reflects a confident, long-term bullish view on the network's security, proving that long-term strategic capital views network security as a profitable industrial endeavor.
And finally, a massive technical win for interoperability and decentralized finance. This is what we call bridging the ecosystems.
This is arguably one of the most significant technical advances this week. Uniswap, which is the leading decentralized exchange, or DEX, now officially supports the Solana blockchain on its web application. This is not a small feat. You are connecting the largest EVM-based ecosystem, Ethereum, with one of the most prominent high-speed non-EVM chains.
Why is that technical bridge so important for the listener, for the average person in this space?
Well, it drastically enhances cross-ecosystem liquidity. For years, capital has been kind of siloed between these major blockchains. Now, by making capital flow much smoother between DeFi's two largest camps, you open up new opportunities for yield, for stability, reinforcing the idea that this technology stack is becoming more seamless and powerful, regardless of today's price tag. So synthesizing everything we've covered, the strategic takeaway is that the market really requires a bifurcated approach right now. The short-term narrative is demonstrably bearish, driven by technical breakdowns and brutal macro risk. However, the long-term fundamental picture state-level adoption, new corporate and Asian institutional capital, and crucial open-source infrastructure, that has strengthened significantly in just the last 72 hours.
So what does the listener need to monitor immediately to understand which of these dueling narratives, the short-term pain or the long-term progress, is winning the day? We have three immediate signals to watch.
First, the technical test. We absolutely must monitor the market's reaction at the $106,000 level. Failure to reclaim and hold that former support confirms a deeper bearish trend and could flush out the remaining weak hands.
Okay. Second, the ETF flows, which act as the immediate institutional referendum. Does the next data set show a continuation of synchronized outflows, confirming the tactical de-risking? Or do we see a reversal back to inflows, signaling that strategic institutional dip buyers are stepping in to absorb the selling pressure?
Exactly. And third, macro rhetoric. Look for any meaningful development in the U.S. China relationship. Any movement that suggests de-escalation, however small, could immediately provide a powerful, generalized tailwind for all risk assets and potentially override the short-term technicals. Finally, let's leave you with the ultimate question raised by this profound divergence we've been discussing. We saw $530.9 million flow out of tactical ETF funds at the precise moment a major state like Florida is proposing to put pension capital in for the long haul. Is the current short-term, pain-driven seller unknowingly selling their assets at extreme fear prices directly into the hands of permanent, decades-long structural buyers? What does that imbalance of time horizons imply for future market volatility once the global macro headwinds finally dissipate?
A truly provocative thought to mull over as the digital asset market navigates this extreme clash between noise and signal. That's it for this deep dive.